Good day everyone. Today our group will presenting on MFRS 137. This standard is a critical in a financial accounting as is a dedication how we handle obligations that aren't exactly set in the stone. Well, we will breaking down how to recognize and measurement provision, contingent, liability and contingent assets. About the objective here is simple. Contingent, we want to make sure that when a company says that own money in the future, they aren't just guessing. MFRS 137 ensures that sufficient information is dissolved in the notes so that investment and shareholder understanding exactly what's happening with the companies and potential outflow them. Before we dive in deep, let's get our terms right. A provision is basically a liability where we aren't 100% sure when we will pay or exactly how much it will be. The most important part is the obligation event. This is the past event that traps the company into having to pay. How do we know when to actually put a provision on the balance sheet? We use the Part 3 part test. First is a present obligation. Second is a provision, probably meaning more likely than not that money will leave the company. And third, we can estimate the cost. If you want to check all three boxes, you cannot record as is a provision. Finally, let's look at where this obligation came from. A legal obligation is straightforward. It is a contract or a law, but a contraction obligation is based on the company behavior. If the company will always pay out for a specific issue, even when they don't illegally have to, they will create a valid expectation in the eyes of the accounting. This is just a buildings as a.
Hi, my name is Nitra Kumar and I will be presenting about measurement of promotion, which will be considered as, and the very first one is about risk and uncertainties, and it is always considered possible variation in outcome. And the second one is about avoid underestimating or overstating the provision, which is it will reflect the realistic expectation of the obligation. And the second one is about future events. For example, when we take into account events that may affect the amount, for example, changes in technologies, law or cost, it will only include when there is sufficient evidence. And the third one is about time value of money. If impact is material, apply discounting. Use present value to reflect current worth of future payments. Ensure more accurate measurement over the time. So the next one is about, let me explain about example product warranty. A company provides a 1-year warranty on its product. It expects the future repair cost of 20,000, which is it creates a present obligation. The provision is required just for the general entry explanation. So the warranty expenses will be in debit, which is 20,000, and they recognize the cost of warranty in the current period. It follows the matching period, which is expenses recorded with related fields. And provision for warranty will be the credit, which will be amounted for 20,000, which is it records a liability for expected future repairs, and it shows the company obligation to customers. Next one is about contingent liabilities. Let's look for the definition. A contingent liability is a potential obligation that may arise depending on future event, and there is few types of contingent, and the very first one is about possible obligation. It will arise from past event, and the existence depends on uncertain future event. For example, pending court case outcome. And the second one is about present obligation, which is uncertain because obligation exists, but payment is not probable or amount cannot be measured reliably. Next, look for treatment of contingent liabilities. Contingent liabilities are not recognized in financial statement because there is no journal entry, because obligation is uncertain, payment is not probable or cannot be measured reliably. When you talk about disclosure in notes, it discloses in the notes to financial statement, which is it will provide information to users without recording a liability. Let me give you an example. For example, pending lawsuit, which is outcome still uncertain, government investigations. This kind of thing is possible penalties, guarantee obligation, which is may need to pay if another party they are not supposed to pay. Let me give an example for this contingent liability. It is about court case. A company is being sued for 500,000. This arises from a past event, which is the lawsuit. Lawyers believe the chance of losing is low, which is it is not probable. Outcome is uncertain, accounting treatment, no provision recognized, and there is no liability recorded in financial statement because payment is not probable. Disclosure in notes, which is the information is disclosed in the notes to financial statement, which is it will help users understand the possible risk. That's all from me. Thank you.
Hi everyone, let's look at contingent assets part. What is contingent asset? Contingent assets are possible assets that arise from past event and their existence will be confirmed by uncertain future events. Okay, in simple terms, it means the company may receive a benefit in the future but it is not guaranteed yet. For example, a company may receive compensation from a lawsuit or an insurance claim but the outcome depends on future events, so it is uncertain. Thank you. Second part is recognition of contingent asset. So that means contingent assets are not recognized in financial statement because the income is uncertain and it may never happen. This is because to avoid overstating income and follow the principle of prudence where gains are only recorded when they are certain. So when to disclose? However, contingent assets can be disclosed in the notes to be in the financial statement. So this is only happens when the inflow of economic benefits is probable, meaning there is reasonable chance the company will receive the benefit. So now let's look at the example part of the legal claim. For example, a company is suing another company for 200,000 ringgit. Since the case is still ongoing, the outcome is uncertain. So it is considered as a contingent asset. Okay. The second one is accounting treatment. First, it is not recognized as an asset because the inflow of money is not yet certain. The second one is it is disclosed in the notes only if receiving the money is probable. Thank you. So this slide shows the differences between provision, contingent liability and contingent asset. A provision is recognized because it is probable and can be estimated. But contingent liability and contingent asset that they are not recognized because they are uncertain. For disclosure, provision and contingent liabilities are disclosed, but contingent assets are only sometimes disclosed. So in terms of certainty, provision is probable while the others are only possible. For example, provision is warranty cost, contingent liability is lawsuit, risk and contingent asset is a lawsuit compensation. Thank you. So let's read the importance of MFRS 137. Okay, what is MFRS? Okay, it is always ensures proper accounting for contingent asset, liabilities and provisions. First, it prevents overstatement of assets by avoiding uncertain gains too early. Second, it prevents understatement of liabilities by ensuring obligations are properly recorded. Third one is it is always ensure accurate financial reporting by giving a true and fair view. And finally, it improves decision making by providing clear and reliable information to users.
Companies are required to provide detailed disclosures about their provisions or contingent liabilities to ensure transparency in financial reporting. Nature of obligation. This explains what the company is actually responsible for, such as legal claim, warranty, or contractual duty. It helps users of financial statements understand the reason for the obligation. Expected timing for payments. This shows when the company is likely to settle the obligation. Whether it is short-term or long-term, it helps in understanding the cash flow impact. Uncertainty involved. This describes the level of uncertainty about the amount or timing of the payment. Since prohibitions often involve estimates, companies must explain the risk or assumption used. Possible reimbursements. This states whether the company expects to recover parts or all the costs from another party, such as insurance or a third party. Reimbursement is likely it is disclosed separately. Practical business examples. For provisions are recognized when a company has a present obligation and the amount can be estimated. Under provisions, there are three. Number 1. Product warranty. Companies set aside money to cover future repairs or replacement costs for defective products sold. For number 2. Employee benefits. Business estimate and record future obligations such as retirement benefit, bonuses, or leave payments. Number 3. Environmental cleanup. Companies involved in industrial like oil or manufacturing may need to restore or clean up environmental damage caused by the operations. Other than that, contingental liabilities. These are the possible obligations that depend on future uncertain events. In contingental liabilities, there is a legal dispute. If a company is being sued, it may have to pay damages depending on the court's decisions. Government penalties. Fines or penalties may be imposed if a company is found to have violated regulations. Number 3. Contingent assets. These are the possible assets that may arise from uncertain future events. Under that